Welcome to Clear Money Talk, where we turn complex financial topics into clear conversations.
I'm Tyler Andrews.
And I'm Tim Claremont. Let's jump in.
Sounds good. Topic of our day is rising debt putting your financial future at risk.
Okay.
So, U.S. household debt recently topped $18 trillion.
Wow.
That includes mortgages, student loans, credit cards, auto loans, the whole kit and caboodle. That's a big number. So we're not talking millions or billions, we're talking trillions of dollars here. So when it comes to financial planning, what we talk about and do every day, debt is a huge topic of conversation. It has hidden costs and impacts, and it has very transparent and apparent costs. And I think talking through the pros and the cons of all those things is important, so that way you can understand where debt fits, where it doesn't fit, and how it might have those hidden costs affecting your wealth building future.
Yeah, no, totally fair and totally on point, Tyler. As I think about the impact of debt, it's certainly gotten much more significant in the last couple of years as interest rates have risen. When interest rates were lower, there were a lot of debt could have been looked at as almost good debt. If you were borrowing money at a low interest rate of say 2.5%, 3.5%, and you were taking that money and then earning something greater than 2.5%, 3.5%, maybe you were investing and earning 5 to 10% in something, you would have actually earned money and grown your net worth. In an environment where interest rates now are, currently anywhere between, let's say, 5 and 10%, in a lot of secured debt scenarios, and then 10 to 25% in some unsecured scenarios, that is pretty much objectively bad debt. That is costing you a lot of money that is going to somebody other than your family, other than yourself, other than fun times. It's going to interest payments to a bank or some other kind of entity that might be loaning you that money. So yes, definitely. I think debt is a huge issue, and paying attention to how you can minimize that expense of interest is a big deal. And so I'm excited to explore that with you guys today. So this will be fun as we dive deeper into it. So Tyler, what are you thinking as far as an agenda and structure for today's call?
Yeah, thanks for asking, Tim, and thanks for that introduction. I think that what you just mentioned is extremely timely. I think in 2025. Where we're at today, interest rates and where they've gotten to at this point are very different than what they were 3 or 4 years ago, 5 years ago for that matter.
Yep.
They're significantly higher. There's no way of hiding around that fact. And that is makes it timely for this podcast. It also brings into the conversation, well, who's it affecting the most? Is it affecting the younger generations with student loan repayments, the housing affordability crisis, if you will, which affordability of housing is extremely an important topic these days.
Yep.
And a lot of people putting things more and more on credit cards and taking on debt just because things have naturally gotten so much more expensive as wages haven't risen to offset those things. A lot of people are just struggling and accumulating more debt than ever at record paces. So
yeah, that's fair.
I think that talking about why it's now more important than ever to talk about it, that's kind of bullet point number one, if you will. We can talk about the hidden cost of carrying debt. And I think that's a good place to go as far as that's concerned. The smart strategies to tackle debt. We have another podcast more related to debt payoff strategies, so we can refer you there, but we'll hit on that briefly. And then we can also talk about balancing debt payoff while also balancing wealth accumulation and building. So
I like all of those structures, but I'm actually going to pivot and go back to one of the things that you said at the beginning, because I think this is even a better 3-step structure, and then we can go into the rest of the steps that you mentioned.
Love it.
As I think about you as listeners and viewers, as you're thinking about your debt situation, a lot of you are probably thinking back to what Tyler said earlier, the student loan debt versus people that are trying to buy a house and that kind of debt, versus what kinds of people are impacted by this interest rate situation. Who is this really affecting in the biggest way possible? And that's kind of like a third subtopic. I think if we hit those 3 first, then we can tackle the rest of the list that you have in mind, because I think that's real. I think you can relate to that. If you're at the phase now where you have a student or you are a student and you're looking at the debt necessary to go get a higher education, that is a massive amount of money. The cost of actually rising tuition and rising costs of school. I actually wrote my thesis on this back in 1997 when I graduated from college. I went to Whitman College in Walla Walla, Washington, and the thesis was all about the irreconcilability of rising costs with rising tuition. It wasn't because costs were higher that they're charging more. It was because the expectation and demand for education was increasing, the population was increasing, and the number of schools and education resources was fixed. And as you have an increase in demand and you have a fixed supply, you see the price increase, which basically means the schools get away with charging you more money because we want them that much more badly. So net effect is you end up having really, really, really high costs. And if you look at the overall cost of education, it's gone through the roof, not just in terms of nominal numbers, but real numbers after adjusting for inflation. So you need to start to rethink education expense. If they're going to pay for your education, if you have a scholarship, great, go to town. But if you're going to pay for your education or your family's going to pay for your education, you want to make sure it doesn't bankrupt you, because it will really change your entire life compared to what it would have done cost-wise in the 90s, and yet alone cost-wise, in the 60s or 70s. My father, when he went to college, was able to work his way through college and pay as he went with no debt. That was not even remotely viable for me between 94 and 97 when I went to college. Yes, I worked my way through college, but that barely covered my room and board. I still going into debt for tuition, and I had to work very hard over the next few years to try to pay that off. Nowadays, you're taking on a mortgage when you go into an education expense that you're going to be paying in many cases for 10, 15, 20, 25 years. And if you're going to take on an expense like that because of this debt, you want to make sure you're going to get ROI, return on investment, on that education. And that's a different way to look at it at this point. It's no longer something that everyone just has to automatically have. You might consider keeping your costs lower by going to community college for 2 years and then transferring to a 4-year university in that last 2 years. That overall total cost would be significantly less, and your degree looks just as good at the end of the 4-year diploma as it does for the person who went all 4 years. On the other hand, one other thing to very seriously consider is these tuition prices are negotiable. You should definitely go and talk to the financial resources department that is available at the school you intend to go to, or your child, or whatnot intends to go to, and have a discussion with them about paying less because this is a bartering scenario. Bartering is not necessarily common in our society in the United States. It's certainly a standard in a lot of other countries. It's one of the ways that people engage in purchasing everything. But this is one of those scenarios where you should definitely go and address trying to get a lower price tag, but pay attention to the overall amount you're investing in your education and how you're going to repay that. How are you going to earn enough money from that diploma that you have in order to cover that? Because it is a different world when it comes to education nowadays. And the higher cost of interest with interest rates going up in the last year and a half only makes it that much more expensive.
Yeah. I think we can do a whole separate podcast on college funding and paying for tuition and all that, because there's a lot of resources and conduits that you can use for your benefit to get through college. And Tim, you always say this, and I think it's a great analogy. You can borrow your way through college. You can't borrow your way through retirement. So we have to make sure that we balance those two ends. If you are somebody that is trying to plan for both of those things or pay for both of those things, there are ways to get through it in a financially responsible way.
Yeah,
So
totally fair.
what was the other thing that you want to talk about as far as the first three?
Yeah, so people purchasing homes. When
Yes.
you're borrowing money to buy a home, and I think it's almost like we go to that third bullet first, the people this is impacting. Many of our clients are between the ages of 50 and 75, and many of them have gotten the debt on their homes to a much, much lower number, and often actually they have their homes paid off. If your home is paid off and you have no debts, this interest rate environment and this entire podcast isn't really affecting you very much. It may be affecting your family members, especially those who are younger or dealing with debt and impacted by leverage. But if you have everything paid off and you have no debt, then you don't really need to worry about this interest rate environment from a cost standpoint. If anything, you want to take a look at an earnings standpoint and don't get too complacent with CD returns that are now going down as interest rates are dropping. And always recognize that the majority of times CD and savings account interest rate returns are usually less than inflation. So even if you have money invested in accounts like that, it's likely that the interest you're earning is less than what the cost of living is. So you need to make sure you're retaining your purchasing power, not just your principal. Moving to the second bullet that we were just talking about, financing to purchase that first house. A lot of younger people are struggling to be able to qualify to borrow the money to buy that first house as the cost of housing has increased so significantly. Again, back to demand and supply. The limited amount of supply of housing that we have in many cases in many areas around the United States, certainly here in the Portland and Oregon area in general, it is driving the cost up for those houses. And it's compelling a lot of people in their 20s to rent. They have to rent because they can't afford to buy. And when they do go to buy, they're leveraging so much that there really isn't a lot of discretionary money left for them to be able to do other things like save for retirement or contribute to a Roth IRA or save for their kids' college, let alone have a vacation and enjoy some life. So the cost of living and owning a home is real and is more significant than it used to be with these higher interest rates. Doesn't mean it's a bad idea though. Doesn't mean that you shouldn't still seriously consider it. A home in general has been an appreciating asset historically, and there's a sense of paying yourself when you're doing that versus paying somebody else with rent. With the interest rates dropping in the near future, it's certainly worth considering what your plan is from a standpoint of owning the roof over your head, and that is something that whether it's possible or just difficult is worth giving some consideration to. If it's difficult, it might still be worth doing it.
Yeah, being house poor is a real thing.
Yeah, it is.
I've seen it. I've seen it firsthand. And when it hits the weekend and you're like, "What are we doing?" You're at home enjoying your mortgage because there's not much leftover money to do more with. So
you can usually barely afford at least one streaming service. So
exactly. What are we doing this weekend? We're enjoying.
We're binge watching. Yeah, it's for again. You're binge watching again. The same thing.
Hopefully, clear is what you're binge.
Yeah, that's right. Yeah, this is free. You can watch this on YouTube and listen over and over again to Tyler and I talk about money.
What was the third thing?
The third that I kind of touched on in reverse order was really who this is affecting, who it's not affecting. I wanted to touch on who it's not affecting as much. If you don't have debt, it's not really affecting you much. Yeah. I will say I'm a huge fan of leverage, and the reason for that is there is such a thing as good debt and bad debt. We've talked about that previously. Good debt is debt that you're borrowing at an interest rate that's less than what you intend to earn. And if the interest is deductible from a tax standpoint, you need to modify the actual cost to consider how much you're saving in taxes. In the state of Oregon, for example, we have 9% income taxes, plus you have a federal income tax hit. You might even have a city income tax hit in county income tax hit in Multnomah County,
yes.
Which can trigger at 3% for the new preschool income tax that they've implemented in the last few years. So imagine 3 plus 9 is 12, plus your federal tax bracket, which could be 22, 24, maybe 31, 33. You add that on top, and actually Oregonians living in Multnomah County subjected to the preschool tax are actually in the top 2 most taxed locations in the entire United States. The only other one that is more taxed is New York City, and frankly, I don't know if it's more taxed. It might even lose to Multnomah County residents in the state of Oregon who are subject to that preschool tax. That is how taxed we are here in Oregon. So if you have an interest expense on your debt that is deductible legally, then what you can say is, hey, my tax bracket is 45%. Overall, as an example, and my interest rate is 10, as an example, to keep my math easy, you're really only paying 5.5% to borrow that money. That 4.5% is essentially subsidized by you not having to pay income taxes on that. So take it like going to a store and getting a deal. When they have 45% off in the window, that's what you're getting for the cost of financing or interest or leverage if you happen to be in a 45% marginal tax bracket when you add up all the taxes that you're paying.
Yeah. Oh man, taxes.
Yeah.
They'll take a chunk. And so will debt. The topic of our podcast is rising debt putting your financial future at risk. And it quite possibly might be. There's the hidden costs of debt, which I wanted to hit on, is that every dollar going to service debt is one less dollar compounding for your future. And long-term wealth erosion a lot of the times can be looked at as, well, we have market downturns and that impedes my wealth building and my wealth accumulation over a long period of time. Well, interest and the payments that you make on loans and debt service can also be a hidden wealth building erosion that's happening a lot of the times behind the scenes that you don't even bring that to the forefront to add those pieces up together. So one of the hidden costs is the long-term effects of it, also the short-term effects of it. A lot of the times we feel debt right now. You're paying for it. It sucks. You have cash flow. You have expenses going out. You got debt. And you can feel it a lot right now, but over the long period of time, if you can see it over a longer period of time, it has those hidden effects on there as well.
I think it's funny that you said it sucks, because it's objective. That's not even a subjective opinion. That is a matter of fact.
Yeah,
it sucks.
It does.
So, it's not fun to spend money on interest. I don't think anybody really enjoys spending money on interest.
If you're receiving the interest,
if you're receiving
the money, you're happy.
Not such a bad deal.
Not if you're paying with. So let's talk about maybe smart strategies to pay it off.
Sure.
We have done other podcasts about this. I definitely encourage you to listen to those ones for more granular detail on these strategies. One of the ones that we talked about in that other podcast was the avalanche versus the snowball method.
Mm-hmm.
I do think that's a great, very basic format to decide on how to tackle paying off debt and in which order do I tackle that debt.
Yep.
The quick summation is the avalanche method focuses on the highest interest rates first to try to tackle those and get those paid off, and then you go to the next lowest, so on and so forth. The snowball method prioritizes paying off the lowest balances first, so that way you have and feel positive progression with paying off your debts, and that keeps motivation towards paying them all off over time. And to each their own. I think every person is going to lean into one strategy over the other differently. There are some general rule of thumbs that you can use with it, but I think bottom line, as long as you're trying to pay off high interest debts, you're at a good starting place.
That's absolutely correct. I agree with the summation that you just articulated there. And I remember from that podcast when we put that together, Tyler was more of a fan of the snowball method. I was more a fan of the avalanche method. So I do recall that differentiation. And I will say that there isn't a right or wrong. They're both good. The avalanche method also will, the reason I'm a fan of it more than the snowball method is it will increase your overall net worth faster. You will pay less money in interest. The snowball method, on the other hand, will create more flexibility faster with your ability to make lower payments if you have cash flow challenges and cash flow crunches, because you'll get rid of some of those debts and your minimum overall payment will go down faster. So both are still good, as Tyler mentioned, to obviously get rid of the debt, drop that overall interest cost.
Yeah, motivation's so huge too.
Yeah.
Paying off debt is not sexy. It's not fun, right?
I kind of enjoy
So if you got a credit card, a car loan, a personal line of credit, and you can pay off the car loan, you're like, nice. Let's go now for the credit card. Pay off that credit card. You're like, nice. Now let's go for the next one. Mm-hmm. You just keep on climbing the rungs of the ladder until you reach the top, and you're hopefully debt free from the bad debt, and maybe carrying some other debt that's good debt.
Yeah, there you go.
Yeah,
good stuff. What else you got?
Another option for debt consolidation strategies is consolidating debt. So refinancing, consolidating debt by moving things around. Tim, you're an expert when it comes to this stuff. Maybe you want to share a few details and quick snippets about that?
Yeah. One of the things if you look at your debt, I strongly recommend, spreadsheets are basically free nowadays. I don't know if you're a spreadsheet nerd and you love them like I do, or if you almost never touch them. But this is an example where it's worth breaking out a spreadsheet. Just type in the debts that who it is that you owe money to in column A, and how much you owe in column B, and what the interest rate is in column C. And if you list those out on your spreadsheet, you're going to start to get a sense of how much you're paying in overall interest. All you have to do, by the way, is take column C and multiply it by column B, the interest rate times the amount of debt you have, and you could put that answer in column D, and that'll tell you in dollars how much you're spending on interest per year. And that will be very insightful for you, because all of that is wasted money going somewhere else. So if you want to shrink the total dollars in column D that you're spending on interest, then what you could do, because maybe you don't have, obviously if you have the money to pay it off. That's choice number one. But if you don't have the money yet to pay it off, you're going to pay it off over time with some of your income and so on. Getting the overall interest rate as low as possible is going to shrink the cost of the interest in column D. So how you can do that is you can look for ways to borrow money at a lower interest rate and use that money to pay off the higher interest rate debt. For example, if you have a credit card debt for, let's say $10,000 that you might owe on a credit card, if it's at 20% interest, it's costing you $2,000 per year to borrow that $10,000. That means at the end of the year, even if you paid it off, you'd have paid $12,000 because you'd have paid the $2,000 in interest plus the $10,000 of principal that you owed. That's a lot of money. Alternatively, what if you have a car that's paid off and the car is worth $15,000? You could actually go into a credit union or a bank and borrow the equity back out of the car for $10,000, pay that credit card debt off, and now your car debt, your new payment on the car debt, could easily be somewhere around 5, 6, 7%. That same $10,000 now at 5 or 6 or 7%, 5% as an example, you'd only owe $500 at the end of the year. Just by moving that debt, you've just saved yourself $1,500 per year in that example.
Yeah,
Fair?
absolutely. I
Yeah.
think arbitraging and leveraging interest rates, which almost sounds counterintuitive. I'm leveraging the interest rates for my leverage, which is debt at the end of the day.
Yeah.
But
Get all your debt to the lowest interest rate possible.
Yeah.
That's the name of the game.
Yep,
Yeah.
absolutely.
Yep.
And my only other recommendation or food for thought here is avoid the quick fix scams that exist.
Yeah.
If you have some predatory things happening, or if you have things that sound too good to be true to fix your debt, it likely is too good to be true. There are no quick fix schemes that exist that I'm aware of to get rid of debt, short of filing bankruptcy or other things. A lot of people try to avoid those though, because those have other cons that come along with it.
Yeah.
So let's talk about balancing debt payoff with wealth building. I
Sure.
think it's not always about debt before investing, which a lot of people think. When it comes to what we do, there is a healthy balancing act between, yes, debt service and prioritizing paying down bad debts, but also at the same time not sacrificing your future and your wealth building accumulation years while they're at your front doorstep.
Yeah, let's take the easiest example of why you should save and instead of paying down debt from an investment standpoint. So if you have a retirement plan through work like a 401k that has a match on it, let's say it matches dollar for dollar on the first 3% of your income, then that means for every dollar you put in, the company is putting another dollar in for you. So if your income in this example was $50,000 and there's a 3% dollar for dollar match, and you put in as little as 3% of your income, that translates to $1,500 per year, a little over $100 per month. Your company is going to give you the same $1,500 out of their pocket. Your $1,500 in savings is now worth $3,000 at the end of the year, even if the investments were 0% rate of return. So forget about investment returns. That's on top of that if you make money on it, obviously. But the point is you're getting 100% rate of return on your contribution. That's what happens when you put money into a 401k with a dollar for dollar match. Is that more valuable for you than the cost of debt at 5 to 20%? The answer is absolutely that's more valuable. It'd be better for you to take that $1,500 and stick it in the 401k, turn it immediately into $3,000 from your company, as opposed to taking that same $1,500 and trying to pay down your credit card debt, even though it's at 20% interest. So you've got to take the match dollars if they're matching you dollar for dollar. If they're matching you 50 cents on the dollar, that's still a 50% rate of return. So you can compare that rate of return, if you will, the amount of match dollars that they're giving you, to the interest rate that you're paying on your debt to decide which one's better. If you get free money to the tune of 50 cents on the dollar or dollar for dollar, clearly you should do that first. Now, once you get done with all the match dollars and you're getting all the match dollars and it is what it is, then your additional contributions to savings are only going to earn whatever kind of investment returns you might earn. So you start to look at what kind of return are you earning on your investments versus the interest you're paying on your debt. And if you can get your overall debt down to a low enough interest rate where it makes sense to pay it off slow so that you could take the extra money and put it in your investments and earn more, you can benefit from the arbitrage Tyler was referring to earlier. That's all arbitrage is. It means you earn one thing here and you pay one thing here and the difference is better for you. At the end of the day, that's what arbitrage is. So if you, that's what you want to focus on. And if you look at that spreadsheet that we encouraged you to build earlier and you look at your average overall interest rate that you're paying on your debt, then you can start to get a sense of, should you be focusing on paying down the debt or should you be focusing on saving? And sometimes it's gray. I would say if you're somewhere between 4 and 8% interest on the debt, doesn't mean you shouldn't be saving. It means maybe you do a little bit of both. Because having the habit in place of saving, even if there isn't a match, just contributing on a regular basis is very important to continue to build in that human element of it. You want to get into the habit of constantly saving. And as your debt goes down and you end up with more money, you might be able to increase the savings along the way as well and improve your net worth that way.
Yeah, I think a good way to summarize that is balancing between short-term relief and long-term growth, somewhere between those two ends.
Yeah, that's
short-term
good.
relief from debt that is overwhelming, overbearing, high interest rates, while at the same time prioritizing and focusing on long-term growth and saving for your future, whatever your future might look like, retirement, buying something, different financial goals and objectives for everybody. And mortgages, credit cards, car loans, student debt, all are going to require a different strategy to pay off those debts. There's not the easy button that it's the same for all those. All those have different strategies that might make sense for those. So, you know, prioritizing what you have and figuring out the best way to pay it off is going to be unique to each and every one of you.
There you go.
Yeah.
We should probably bring it to Adjust the Answer and wrap this thing up.
Let's do it.
All right.
Just the answer. Topic of the day, again, is rising debt putting your financial future at risk. We talked about how the U.S. national debt, consumer debt, just reached 18 trillion. We're recording this in September 2025 right now. I assume that will continue to go up as debt naturally does. We talked about why this matters in 2025 more than ever. Interest rates are at, I don't want to say all-time highs because that would be false, but they're at highs. If you look back over the last 5 or 10 years, they're definitely at some of the highest points. So it's being felt more than ever by consumers right now. And also a lot of people are just feeling debt more than ever right now with the rising cost of goods. A lot of people are taking on more debt just to live a normal lifestyle. The housing affordability crisis, as we coined it, as another factor that is weighing on people's debt and the amount of debt they're carrying. There's a lot of different factors going on. Your student debt, we talked about that. That is continuing to rise and become more expensive and more unaffordable over time. So all these things are compounding, and that's why it's such a relevant topic in 2025 right now. We talked about the hidden cost of carrying debt. Every dollar that you're paying to service debt is one less dollar saved and compounding for your future. And the long-term wealth building erosion of that is not insignificant. Over time, it just continues to compound and compound on itself. And although in the short term it might seem negligible, over a long period of time, it is exponential, if you will. Smart strategies to tackle debt. We talked about the avalanche versus snowball method. We have another podcast on debt consolidation and debt payoff strategies. I definitely recommend you guys go and listen to that. It has other good takeaways and feedback worth listening to. Tim talked about refinancing versus consolidation, how to arbitrage and balance your interest rate so that way you're paying the lowest possible interest rate, and we can use that to pay off other higher interest rate debts. And avoid the quick fix scams that exist out there. The predatory pay off your debts quick scams that exist. A lot of those are not feasible, they don't exist, or they're usually too good to be true. So just be wary of those things. Last, we talked about balancing debt payoff with also wealth building and wealth accumulation for your future. So it's, Tim, you did such a good job of explaining that. I think the long version of the podcast is going to be the best bread and butter for this thing, but balance short-term relief with long-term growth is a good way to summarize that. Make sure you're doing a little bit of both and you're not missing out on things that you otherwise can't go back and get if you miss out on it today, such as things like retirement contributions, matching dollars from your employer in a 401k plan or equivalent, and making sure that those two ends are giving consideration to and that you're not missing out on anything, that you might have FOMO later on.
Yeah, FOMO, fear of missing out. Incidentally, the only other thing I mentioned is at the beginning of our long version, if you're listening to this short version, is we did talk also about very specifically about student loan debt versus building up your mortgage debt and whether that's a good situation or not a good situation given the current circumstances, as well as those people who the debt doesn't necessarily affect as much if they've got things like their house paid off and all that good stuff. So go back, listen to the whole version of the show to get more details there. Good job. Good summary.
Thank you.
Yeah.
Good job for you,
Excellent.
too. You ready for some trivia?
Yeah, let's hit it. Let's wrap up the trivia as usual. Stump the nerd. Okay. All right.
So to keep the theme the same, I like keeping the theme the same, the trivia and the topic of the day. So Tim, I want you to tell me what product was famously launched with the slogan, "Don't leave home without it."
Oh man, I've heard this so many times. Don't leave home without it.
That's a multiple choice if you want it.
Oh, I
You're more than
almost
welcome
don't want to because don't leave home without. It's a credit card, I think. That was like.
I'll give you that. It is a credit card.
Yeah,
Yes,
it's a credit card. So, oh man, it's American Express, Discover, Visa, Mastercard. I don't know. I feel like it was American Express, but that's my gut. My gut says American Express. Don't leave home without it. But yeah.
You did well.
Yay!
American
Sweet,
Express.
sweet. Okay, great, awesome. There
The
we go.
campaign launched in the 1970s and became one of the most iconic credit card taglines in history.
There you go. American Express. Don't leave home without it. All right.
There you go.
Got
So
it.
whether you learned about American Express today or you learned more about debt and consolidation strategies and how it might be affecting your financial future, regardless, we appreciate the minutes you spent listening to us.
Yes, and thank you for joining us on Clear Money Talk today. If you have any need for a second opinion or you're looking for a financial advisor, don't hesitate to reach out. You can reach us at 503-579-1000, or you can check us out on the internet as well at clearfp.com. That's clear, C-L-E-A-R, F as in Frank, P as in Peter.com.
We'll see you next time.
Bye-bye.
Tim Claremont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetera Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.